Swing trading and day trading are really similar in terms of the market outlook as you approach your trading day. But the main difference is going to be that the amount of time you're going to spend in the market. Now, swing trading opens up the possibilities of, say, holding a position into the next trading session or next trading day. So you're going to have to start thinking about overnight risks and costs, and that's all going to have to be factored in. And the good thing is that you don't necessarily have to sit in front of the screen or actively participate in the markets, whilst you're waiting for one of your day trading swing setups. And the swing itself refers to the market turns. So as an asset, goes through the course of its life, it's not going to go up in a straight line or straight down, or even in a 45-degree linear sort of manner. The swing itself will be the trade that comes up to the market top and then back down on a pullback. And those swings are where the swing trader will look for market direction and look to get in on that trend without exposing themselves to too much risk. So buying low, selling high, and then going to look to capitalize by then identifying the next potential area for a turn, or they're going to wait for the market to turn just to get out of their position.